The story starts on a Friday in October 1929 with a shoebox under a counter. A 22-year-old clerk at a Manhattan department store slips his paycheck inside, along with a handwritten note, 10% margin. He isn't buying shoes, he's buying stocks. Everyone is. Clerks, chauffeurs, school teachers. The street talk says there's a staircase to easy money, and all you need is the first step. You put down a little, you borrow the rest, and the ticker keeps climbing. What could go wrong? By Tuesday, he will know. If you want to understand why the Wall Street crash became inevitable, follow the staircase down from 5 mistakes, ordinary choices that added up to fragility. None looked catastrophic in isolation. Together, they built a market that couldn't bear its own weight. Mistake 1 was confusing access to credit with safety. In the late 1920s, call money let you buy $100 of stock with $10 of cash. The other $90 came from a broker's loan callable at any time. So long as prices rose, leverage looked like genius. But leverage doesn't just amplify gains, it shortens time. If prices dip, your broker calls. Either send more cash now or we'll sell your shares now. The market didn't need a grand theory to break. It only needed a morning when too many small dips triggered too many small calls all at once. People think crashes arrive because a single giant sells. Often, they arrive because thousands of little balances run out of time on the same day. Mistake 2 was stacking that leverage inside glittering wrappers, the investment trusts. Think of them as the hottest funds of their era, companies that owned other companies, often financed with their own debt, then sold to the public as a way to own America. Some trusts even bought each other in pyramids of cross-holdings. Prices detached from earnings, stories replaced scrutiny. When the top layer wobbled, the whole tower shook because each dollar of true value supported several dollars of market dreams. You can't build a lighthouse out of mirrors and expect it to stand in a storm. Mistake 3 was believing a rigged tempo was the same as stability. Pools of powerful traders cornered thinly traded stocks, bidding them up in choreographed waves, then dumping them on the public once newspapers echoed the action. The ticker, printing prices on paper ribbon, ran minutes behind when trading turned frantic, so Main Street chased ghosts while insiders moved to the next target. The appearance of order disguised a market tuned to speculation, not investment. When confidence slipped, there was no bedrock to land on, just layers of imitation demand looking for the same exit. Mistake 4 was thinking prosperity could outrun the math of the real economy. Industry poured out cars, radios, appliances. Farms produced more than they could sell. Profits at the margin relied on volume continuing to explode. Underneath the headline, boom, credit strains were already visible. Farmer foreclosures, a slowing Europe, trade tensions. Policymakers focused on speculation as if it were an isolated fever, lifting rates to cool the market, while the broader system, banks, merchants, exporters, leaned on the same fragile credit. Cooling the temperature didn't heal the patient. It tightened the tourniquet around circulation. Mistake 5 was building the financial plumbing on trust alone. Banks and brokers depended on short-term funding that rolled every day. As soon as lenders hesitated, liquidity didn't taper. It vanished. A few forced sales knocked prices down. Lower prices triggered margin calls. Calls forced more sales, and the loop fed on itself. People remember Black Tuesday as a single waterfall. In reality, there were several violent declines. Thursday, Monday, Tuesday, each teaching the same brutal lesson. A market built on borrowed breath can't hold it when fear starts to run. Go back to our clerk. Monday morning, the phone on the sales counter buzzes. His broker wants more cash. He doesn't have it. At noon, he watches a customer set down a newspaper with the headline, "Ticker hours behind." By closing bell, his shares have been sold to cover the loan. He hasn't just lost money, he's lost the future income he thought those shares would produce. That's the hidden cruelty of debt-fueled booms. When they end, they don't only take your principal, they steal your story. There were other forces, of course. Bank balance sheets thick with loans to brokers. A global economy still healing from war. A central bank learning in real time how to fight speculation without strangling credit. But if you strip the complexity to a clean blueprint, the crash followed a chain reaction. Easy credit drew in leverage. Leverage sought vehicles. Vehicles invited games. Games raised prices above cash flow. And short-term funding ensured any stumble became a stampede. The aftermath turned financial stress into human crisis. With prices shattered, collateral shrank. Bank failures spread. When banks fall, businesses can't roll loans, inventory piles up, and layoffs follow. Households cut back, which crushes sales, which forces more layoffs. Markets don't live in a separate universe. They're the bloodstream of hiring, production, and rent. The crash taught that a credit event can become an employment event faster than anyone wants to admit. So why tell this story now? Because the architecture of fragility doesn't age. Leverage still shortens time. Vehicles still promise painless diversification and sometimes deliver concentrated risk. Market liquidity still means great until I need it most. And funding models that rely on rolling short-term money still assume tomorrow will look like today. There are differences today that matter. We have circuit breakers, deposit insurance, lender of last resort facilities, more transparent data, and a central bank with a century of crisis playbooks. But those are safety nets, not substitutes for judgment. A portfolio stuffed with long-duration assets funded by fickle money will still feel a small price move like an earthquake. A business financed on terms that all mature in the same quarter will still discover refinancing risk is not a spreadsheet sell. It's a cliff. The counterstory is worth telling, too. Plenty of investors in the late 1920s bought boring companies with real earnings and little debt and simply held on. They watched prices tumble, dividends trimmed, then eventually recover. Survival didn't require clairvoyance. It required avoiding the 5 mistakes long enough to stay in the game. The same is true now. If your time horizon is honest and your funding matches it, volatility is weather, not a verdict. That young clerk eventually worked his way into the store's accounting office. He learned to read ledgers the way some people read faces, where the stress hides, where the story is flattering, where it's true. He never bought stock on margin again. Years later, he told his grandson one sentence that distilled it all. You can borrow money or borrow time. Pick time. 5 mistakes made the Wall Street crash inevitable. Mistaking credit for safety, building towers of leverage, confusing manipulation with stability, believing prosperity could outrun arithmetic, and relying on funding that disappears the moment you need it. If you remember them, you don't need to predict the next headline. You just need to keep your promises aligned with cash flow, your capital aligned with time, and your curiosity sharper than the story being sold. The market will always offer staircases. Some go somewhere, some are painted on the wall. Before you climb, check what's underneath. If this helped you see the steps more clearly, stay with Money Lore. We translate market legends into working maps, so when the crowd runs, you know when to step aside, when to keep walking, and when to take the stairs 2 at a time.